This episode is sponsored by Lupton Capital, which provides a variety of investment services to both retail and institutional investors on platforms such as Seeking Alpha, Substack, and StockTwits. For more information on these services or for links to those services, please visit luptoncapital.com. Hey, everybody. Welcome back to the Investing with the Whales podcast. My name is Jonah Lupton. I'm obviously in my living room. Very excited for our next guest today. It's Ayesha Tariq.
Yes.
Nailed it. Co-founder of MacroVisor. So I know you follow macro a lot. So let's start with macro. We have the FOMC meeting next week. We get CPI next week, the day before, I think, FOMC meeting or FOMC decision. So I think the market thinks we're going to pause. I think you think the FOMC will probably pause, but they're probably not done, in your opinion. And let's start with that. So what do you think about FOMC meeting next week? And why do you think that they're probably not done?
Right. So we're exactly a week away from the rate decision now on Wednesday. So look, historically, if you look at the way the FOMC has been raising rates, not this rate cycle, but previous rate cycles, you'll notice that they raise rates, then they pause, or not rather pause, but they give it a gap and then they raise again. So this rate cycle has been very unusual in that way, that we've had rate hikes, every single meeting. And moreover, not just rate hikes every single meeting, but a higher rate hike progressively, right? So I think it's about time. So we're about 15 months from the first time that they started hiking. And we've seen remarkable progress in inflation. For sure, we have some ways to go. But at the same time, I think inflation has come down almost by, I'd like to say 60% of where we were, right? And so this is good progress. And the theory is that whenever you have rate hikes or you have a hiking cycle, it usually takes about 18 months for it to play out. So there's always a lag, right? And I think Powell has been saying this a lot as well. So this is about a good time for them to sort of pause and, check what's happening in the economy, take stock of everything that's going on before they can think about hiking again. So I don't think we're done. I think we might have one more rate hike after this. And particularly because of the labor market. So the labor market has been the one outlier in all of the data that we've been seeing, right? So everything is falling, everything is negative. But when you look at the labor market, you feel like nothing's wrong.
Why is that? Why has the labor market remained so strong? I think it was last Friday or the Friday before that, we got the jobs report. I think it was 339,000 jobs added in May. You talk to people and it's like everyone thinks the recession's coming, but companies are still hiring. So why is there this big disconnect?
So I think, look, I know a lot of people have been talking about the calculation of the labor market data and some of the adjustments that have to be made there. And because of the adjustments, we're seeing, sort of two sets of data. We're seeing data that's lagged. And obviously it is lagged data. But if we look at it from, a global picture, let's just break it down in a very simplistic manner. So what happened during the pandemic? People were at home, right? A lot of people quit their jobs. So for example, if you look at the healthcare sector, a lot of people quit jobs, right? You would think that, that would be the time when people would want to go to work, but they weren't. First of all, the demand wasn't there. And secondly, people were scared to go to work. I mean, working in a hospital during COVID was terrifying, right? Yep. And then you had the situation where they started mandating COVID vaccines. Now, a lot of people were skeptical about the vaccines. I'm not going to make any comment here whether it's good or bad or anything of that sort. But personal feelings aside, people were afraid to take the vaccine. So they thought, you know what? Let's just quit. It's better for me to just stay home and not go back to work. At the same time, you had all this stimulus money come in. So people were okay, right? They were okay not going back to work. They could manage with not going back to
And
work.
on top of it, their home prices were going up, their stock portfolios were going up, so they all felt wealthier, even though they didn't have any income.
Absolutely, absolutely. I mean, I've heard of stories where people were sort of making more than they were making at a job, just staying at home, not doing anything. So it's not even that they did a work from home kind of thing. It's doing nothing, just investing and staying home, and they made good money. So all of these things combined led to a situation where you obviously had more vacancies versus people going to work or going back to work, and a lot of that still hasn't resolved, right?
I
So
mean,
you still
that's the JOLTS number, right? The JOLTS number,
correct.
the job openings.
Correct. So you still see job openings much higher than what the actual jobs are, or the number of people willing to work, let's say, or willing to go back to work even. And now you have a situation where you still have people not wanting to go back to the office. So again, you have another wave of people quitting jobs. But then on the flip side, you also have the situation where employers don't want to let people go. So it's a weird situation, and it's kind of hanging in the balance right now. So on the one hand, you have people who don't want to go back to work. And on the other hand, you have a situation where once an employer has got people back, they don't want to let them go. So again, because I've done some work on, the healthcare and the labor force there. So I can tell you that there's a lot more flexibility in the nurses and the physicians coming back to work, right? So even if people are coming back to work, hospitals are allowing them to work fewer hours, giving them more flexible timing, giving them, perks, let's say, so that they do come back and stay back, right? So this is a big issue here, that people who have been able to hire, employers who have been able to hire, don't want to let that go. So, and you see this in, for example, the restaurant sector, you see that in leisure and hospitality, and you see that in healthcare particularly. And that's where the bulk of the jobs have been created, the service sector, service oriented industries. And these are obviously more like, let's say in the professional services, these are more skilled workers. And again, you don't want to let them go. So I think this is a situation that cannot last, unfortunately. So what we are seeing, and people are saying, and this is where, the calculation issue comes in and the lag issue comes in, where people are saying that, all the unemployment numbers that should be are not being reflected right now. And perhaps in the next couple of months, we will see more of that.
So if that's true, if the unemployment data is not accurate, and maybe, so are you saying that the true unemployment rate is higher than what's being reported, or that we're not really adding as many jobs, or we're not counting the job losses correctly?
There is some of that. There is some of the adjustment factor that hasn't really been fed through properly. So yes, there is a lag between the actual data and what we see. Because if you look at what we've been hearing, Jonah, about, say, for example, the tech sector, right? All these job losses in the tech sector and the banking sector for that matter. Okay, where are these going? So we haven't really seen the full brunt of that as yet, right? And there's another reason for that as well. Some of these have a long, let's say, runway until they actually are unemployed, because some people are given 3 months, 6 months severance packages. Some people are given, for example, a gardening leave of 6-9 months before they're let go. So it's not like, so today, if I announce we're going to, let go of like 100 people, I'm not letting go of them today.
Right.
So these 100 people will be let go over the course of the next 3 months, 6 months, right? So I think a lot of the announcements that we've already gotten are going to start to appear in the job numbers sooner and sooner.
Okay.
Yeah.
So the FOMC always talks about their 2% inflation target.
Yeah.
What if we get, do you think we can get down to 2% without needing to see the unemployment rate go up to 4.5%, 5%?
No.
You think we need to see unemployment that much higher?
I do think we need to see at least cross the 4% mark for,
Yeah.
I mean, we're at 3.7 now, so 4% is not very far off. But yes, I do think we will see a rise in unemployment if we want to get back down to 2% inflation. There's still a lot of froth in the market, and we can talk about that a little bit
Well,
in due course.
just look at Meta. I mean, Meta, I think, has announced something like 40,000 layoffs over the last 8 months, 9 months. I mean, I think they peaked at 88,000 people, and they're probably going to end this year at half of that. Like, what the hell? What did those 44,000 people do that now they're suddenly expendable and they weren't before? Like, that's just mismanagement by companies. I mean, that is just horrible over hiring and, way too optimistic on the future prospects of their business, I guess. I don't know. Like, if you're a shareholder in Meta, you got to be pissed that they hired 40,000 too many people. And then how many other companies, have too many people sitting around doing nothing?
Absolutely. I mean, look, they're talking about the year of efficiency, but if you're a well-run company, you should have been efficient all the while, right? And look, I understand the bull case for hiring when you do have a lot of free money, when you have like 0% rates in the system. You think you can invest a lot, so you think you can grow very, very fast. So you're going to need all those people. But if you're cutting half your workforce, that's a bit much. And that, I think, is poor planning. So if they had let go of like 10% of their workforce or 15% of their workforce, I would understand. But 50%, that honestly is poor planning.
And to be honest, if Apple's Vision Pro is everything I think it might be, it could put like a nail in the coffin of Facebook's Reality Labs. And then we could see another, round of layoffs from that. So Facebook might not be done. Before we move on to the next topic, do you have any thoughts on Apple's Vision Pro?
So I think I've been the only one who hasn't tweeted about it. Look, I'm a big fan of Apple. Everything I have is Apple. Okay. And I have a motto as well that I never short Apple stock.
Oh, no.
Yeah, no, I never do.
Way too many other companies were shorting before Apple. Yeah,
exactly. So I'm a big fan of Apple. I'm a big fan of what they do and how they do it, right? So look, I think the Vision Pro, for sure, it is overpriced. Okay. But then at the same time, what they're trying to do, and this is just my 2 cents from what I saw, with their little video that they put up. They're trying to replace your TV. They're trying to replace your computer. They're trying to replace screens. So it's going to be a very immersive experience. Whether it's going to be good for you or not, that's a moral, argument that's different. I'm not going to go there.
Right.
But I think if you add up all the stuff that they are trying to replace, that's sort of where they've priced it. I still think it's expensive because you're pricing out a huge, chunk of the population. But then who's to say that they're not going to come out with a cheaper version, which they've always done, right? So they've always launched something. And this is the interesting thing about Apple. Most people launch the cheaper product first. Right. And then the more expensive one. Apple always does the opposite. They always launch like the most expensive product first. Because I remember like the MacBooks used to be something like $2,000-$3,000 at one point. Now you can get it for a significantly cheaper price point.
You get the MacBook Air for I think $999. I almost wonder if they price it really high in order to attract like the really like the Apple cult. Like the fanboys and the fangirls that will pay almost any price, and they love Apple products so much they're willing to overlook some of the small glitches in the beginning. I mean, at that price point, like you wouldn't hope that there'd be any glitches, but I don't know. It's interesting. I'd love to get into their minds and know how they came up with $3,500.
So look, whatever they do, however they do their marketing, and it's a very reverse marketing, reverse psychology marketing, but it works, right? I mean, you see people rushing to the Apple store to buy whatever there is. I have friends who wouldn't even touch the lower priced Apple Watch. They want the more expensive one. So you see all of that. I
I have,
have the cheaper one because I'm not an Apple Watch person. I'm an actual watch person.
I
So
think, I think I paid $700 for it, and I think I've worn it twice. So
yeah, so
I just don't like having anything on my wrists. I don't like wearing watches anymore. But I'm a
fair
fanboy, so
enough.
of course I had to buy it. Um,
I bought it for the exact same reason, by the way.
I mean, the AirPods. I don't have my AirPods with me, but I remember when the AirPods first came out, people were skeptical about those, and now you walk into you walk on into the airport, into a business meeting, into the office, the subway, and that's the only headphones that people wear now. It's like the AirPods and nothing. Oh my God, it's right. I just took mine out when I came back from the gym. They have absolutely taken over that market, and there's like
They
I don't even know
have.
who the number two player is. I guess
And
Beats.
they're good quality, right? So the
Yeah.
quality is great. And surprisingly, they fit really nicely in your ear. They don't fall off. I don't know. Look, again, I guess we're fans of Apple, so we can make every excuse in the book for their products. But at the end of the day, there's a reason that they're the biggest company in the world because they do make good products.
Yep.
So
So,
I think there's no denying that fact.
so let's talk about commercial real estate real quick. So I just saw a tweet a few minutes ago before we jumped on that I guess George Soros's fund is now shorting bank stocks because he thinks there's going to be more bank failures. And just in full disclosure, I despise George Soros, but that's a different conversation. He's been a good investor for many years. I'm sure a lot of people listen to him.
Mm.
Do you think we're going to see more pain in the banks, especially the regional banks, the ones with a lot of commercial real estate exposure?
Look, I'd like to say no. I wish I could say no. But I don't think that will be the case. I do think we will see some more trouble. I don't think it will be on the scale of Silicon Valley or, what was it?
Like Silvergate, First Republic, yeah. Cedar,
First Republic. So
yeah,
First Republic was huge, right? So I don't think it will be at that scale, but I do think there will be a lot of smaller banks, maybe not blowing up, but what might happen is you might have like bank mergers and you'll have
right.
takeovers, you'll have some, because they'll see it coming, right? So now that we've set the precedent that a bank can blow up and not
Like
just one, three banks blow up
very quickly in a matter of
very
days.
quickly.
Yeah,
Exactly. And you know that there's not going to be another JP Morgan coming to save you.
right.
So I think what would likely happen is then if the banks are smart, this is what they will do. They will preempt that by, doing mergers or acquisitions.
Because
But I do think, but it's not going to be an area of growth. That's for sure.
oh no, God no. I just wonder. You think about New York, San Francisco, Los Angeles. All of these downtown commercial buildings that are 50-60% vacant right now that are loaded up with debt, and whoever bought that building put in 20% equity, and then the bank owns the other 80%. And if the building's now worth 50-60% less than when they bought it, there's no point in that developer, whoever owner putting in more equity. They'd rather just ship the keys back to the bank.
So yes, and I'll tell you, I have a bit of experience with this because I was managing real estate in 2018 when they started hiking at that time. So I used to work for a local company over here, a big, family office, and our primary investments were hospitality, so big hotels,
Okay.
real estate, and listed equities. So we had a sizable portfolio, about $1 billion of, assets. And, when you have rates going, and believe me, 2018 was a really tough year for me. When rates were going up, I had sleepless nights because you have a double whammy here, right? So when rates are low and you're valuing these real estate properties, and when I say real estate, I also mean like hotels as well. These are also commercial real estate, right?
Yep.
So, and you have these properties, when rates are low, the valuation is obviously higher, much higher. And that's how any asset works, right? And you have the valuation coming down, and most of these are funded by, floating rate debt. So you have the valuations coming down, you have your interest payments going up, And it's a double whammy. So
And
it's
then
really scary.
it's like a triple whammy if you have cash flows into the business also coming down.
Exactly. And then there's the matter of occupancy, right? So if you don't have the occupancy, and here for the offices, for example, you have forced unoccupancy or forced vacancies where you can't do anything about it. It's not about just letting people go, but people just don't want to come back to the office.
Yep.
What you going to do, right? So, and you have to give them like a hybrid working situation. And when it's hybrid, then you don't need two desks. You can just have one desk which rotates. So there's been a lot of changes in that industry, and I think it's going to be hit really hard because you've got about, I think, 1.1 trillion of debt coming due in the next 2 years, like this year and next year. And then you also have the situation where I think about 40 to 45% of this debt is on floating rate debt.
And a lot
Okay.
of that debt's going to be unrefinanceable, right?
Yes, because of the equity factor, right?
Right.
So when the valuations drop, you're going to have a
Your
situation where you
equity's
have, yes, and you're going to have a loan which is 100% of your value, or even maybe more than the
Right,
value of your
right. You're
business.
underwater. Yeah. So it's like, what the
Yes,
hell? Just here,
yes,
take my keys, take the building. I'll see you later.
yes. And I'll tell you something. So, and this is, I think, something that not a lot of people have been talking about in terms of the hedging factor. Okay, so when you take out, so when you have floating rate debt, the smart thing to do when interest rates are going to go up is to fix your interest rate. So you take out an interest rate swap with a bank, right? And that's what we did at that time as well. But the problem is you can't sort of fix 100% of your debt. You always want to leave like 50-50, or like some part of it floating, some part of it fixed. That's one factor. But the other problem is what they did in 2018, 2019, it blew up a lot of hedges, right? Because people fix these loans for the next 5 years, thinking that the interest rate is going to go up to a certain level. And then they cut the rates. And so a lot of these hedges went underwater and people were bleeding on them. So this time around, and I believe this is what happened with a lot of the banks as well. They thought that they might cut or they might not hike that much, and definitely not that quickly. So
Right.
they would have time to take out the hedges.
Right.
And B, they were scared about what happened in 2018 when their hedges blew up. So this time around, and I've seen so many finance managers get sacked because of hedges. You won't believe it. Like, it's scary because people don't always understand the calculation and what's going on, right? But when they blow up big. And so I think another reason people didn't take out hedges were they were scared. They burnt their fingers last time. And this time they said, come what may, we'll just let it be. And we won't take out hedges that much. And then you have a situation where the hiking or the way the rates, increased affected you even more.
I mean, with Silicon Valley Bank, I could be wrong here, but I'm pretty sure I heard someone say that their average duration in their treasury portfolio was under 5 years, but
Yes.
because they hiked so freaking fast, it didn't matter. Like that's
Correct.
not a long, it's like they were buying 20, 30-year paper. They
Yes.
were buying 3, 4, 5, 6-year paper, but they
Yes.
still got smoked because of Powell.
You're 100% right. I think the average was somewhere around 4.1 or 4.2. And even I was kind of surprised. Like, and I made this comment on Twitter saying, I can't believe they didn't hedge. But then I realized that no, they were kind of okay actually in the way
Yeah.
they managed their books.
That's pretty short-term paper, for a bank. But I guess
Yes.
when they hike 500 basis points in a year, it
Yes.
doesn't matter what you own, it's going down, at least in terms of fixed income. What else? Okay, so I know you publish a newsletter, MacroVisor. What do you guys typically talk about in there? Like, what have been some of the hot topics recently?
So basically, okay, so what I do is I do put out a daily news, which is free for everyone. So if anyone wants to sign up, and they get like daily news, but from across the world. So I try to focus a little bit more on Asia and Europe because we
Okay.
know what's happening in the US. Most people are US based. They know what's going on all the time. But I try to include global macro a little bit more so people understand, that implications of Japan easing or China pumping stimulus. And these things obviously affect, the US market as well. So it's good to know these things. So that's the free portion that we put out. But also we cover all the data points. So most of the important data, we write like short articles on this data. We put out macro-based ideas, and every week or 2 weeks, we try to put out like a longer thematic sort of article on macro themes. And we also have a podcast. And during earnings season, we also did earnings previews for the week. So lots of stuff going on.
So what's going on in Asia and Europe right now? Because I agree that most US investors probably don't follow it that closely.
Correct. So I'll take Japan. So we know that, and I'll run it down very quickly for everyone. So Japan, we had the change of the governor. There's a new governor in. He's an academic versus a politician or, economist. And when he came in, everybody thought he's going to be changing the policy to a tightening policy, but it doesn't seem to be the case because he's focusing very much on the consumption side of things. So basically, Japan has been seeing their inflation go up, and that's what they want because that's healthy for them, for the inflation to go up. They want wages to go up. Unfortunately, this is not driving up consumption. So we did see, in fact, yesterday or today, we saw consumption numbers, real consumption numbers come down. We saw real wages come down, right? So, and this is not what they want to see. What they want to see is a healthy level of consumption in the economy that's going to drive economic growth versus supply side inflation, which is what they have been experiencing. So everybody thought that, tightening was going to be on the horizon. It's not. It seems like they're going to keep the monetary policy eased for now, or it's going to be an easy monetary policy. And this in turn obviously means that their stock market goes up and there's a lot of liquidity created there. And I just posted something today that showed that Japan is the largest buyer of US Treasury bills. Okay, so they have, I think, 1.6 trillion as of the end of last year. So more money in that system will also mean they buy Treasury bills here as well, because the rate is significantly higher. And now you have like AAA paper at almost 4%, right? So that's very lucrative for them, for anyone, in fact, who has the money to buy it, and they do, right? So that will pump in liquidity into the US, and that has been doing so actually from the beginning of the year. That's been one of the reasons that the market has been, going up, rallying. And then you have China. So I'll run that down very quickly. So China, everybody thought we're going to have the great reopening and everything's going to be hunky-dory. Unfortunately, that's not the case. Today, we got export numbers from China, which show exports are down 7.5% year on year. That's a massive drop.
Is that exports out of China, generally speaking, or just from China to the US?
Generally speaking, for the country, right? But then if you consider that China is the manufacturer for the world and the world's biggest exporter of all kinds of goods.
Right, it's a big number.
Yes. So that's a huge number for everyone, for the globe, right? So globally, the whole world has stopped buying goods. And this isn't a good thing, right?
How much of that is because are companies finally starting to move manufacturing out of China, either for political reasons or because of what happened during the pandemic?
So look, I think there has been a lot of nearshoring. Yes. The term nearshoring, moving manufacturing out of China, there has been some of that, but not enough to cause a drop like this. Okay. So I would say maybe that would account for 0.5, 0.75, maybe even 1%, but 0.75% year-on-year drop. That's simply goods demand coming down. This is the effect of rate hikes and demand destruction.
I remember during the pandemic, they were talking about all the ships in the port of LA.
Yes.
And I don't know if those ships are still out there. I think they've already offloaded them, and there's nothing floating out there anymore.
Not really, no. So that situation has been resolved, and a lot of it is because of your goods demand coming down, right? And like that congestion and everything that was stuck in the supply chain, that's like all, not all, but most of it has been resolved now. So we don't have that situation anymore. But what is very alarming about China is just two things. One's the fact that people are not buying goods, so manufacturing is not there, industrial production is not there. On the other hand, you have a situation where their property market is blowing up. Okay. So yesterday I put out some data that, I think about 48% of, I can't remember the number, but let's say around 40% was the number which was on the brink of default. That 40% of real estate debt was on the brink of default.
Is that commercial or residential?
Commercial, mostly
Really?
commercial. No, actually a mix. So it was like the total property sector. So it's not commercial or real or residential. So
what would be causing that? I mean, are they having like a recession? Are wages going down? People losing jobs because of COVID, and now they can't pay their bills?
So a couple of things. They overbuilt. Okay.
Right.
They overbuilt in certain areas and then again not. Then we had the COVID situation that led to a lot of this debt not being paid and like people not making their payments. So one thing that China does, and we do it here as well, they sell properties off plan. Okay. So basically they sell you the property or on a payment scheme before they even build that property.
Oh, because remember, we've seen that there was a video that went viral like 6 months ago of them blowing up like 20, 30 uninhabited buildings. Have you seen that video?
No, I
Oh my
didn't.
God, it's crazy. I mean, there was like 20 or 30 buildings that they built, I don't know, 3 or 4 years ago. And I don't think anyone ever moved into them, and they just blew them all up.
Wow, that's pretty interesting.
I'll try to find it. Yeah, it's wild. So that's just an example of some of the overbuilding they did.
Yeah, because look, I think what happened was, look, obviously, as people started to become affluent, they started to buy second and third properties. And when you had these property plans that where you could put like a very small down payment, and then you could, you had like 2, 3, 4, 5, 6 year plans where you could actually buy this property. So I think all of that drove a bubble in the property market. And now that's all collapsing. A lot of these developers have finished buildings. The price of debt had gone up. They took out US dollar bonds, and then you have the US dollar getting stronger. So that so it's a mix of things. But suffice to say, their property market is in trouble. So when the property market is in trouble, you have two things. You have the government sort of trying to prop up the property market with stimulus. And a lot of these funds have been diverted from infrastructure, production, manufacturing. So where these funds should have gone for something else, for productive activity, it's now going to sort of prop up the property market, which isn't really productive or helpful. And then secondly, you have the situation where, because there's this shift and there's actually no production, you don't have a commodity boom coming as we thought it was going to come. Okay, so I think the whole premise of oil prices, reigniting, copper, all of these things, most people thought that we would see some stability in the prices because China would offset some of that demand, right? So because we have a situation where we have a recession and demand falling, but a lot of people thought that would be offset by Chinese demand because of the reopening. Unfortunately, what we're seeing is that the reopening is being led by services. So people are still okay to go out and spend on services, restaurants, eating, these kind of things, travel, leisure. But people really don't want to spend on property. So they're still saving, okay, because they're still a little scared.
Kind of the same in this country, right? People in this country are spending on services. We're all done buying couches and TVs.
Yes. But so the US is done buying couches and TV. China, on the other hand, they don't want to buy those couches and TV. I mean, now they have the money, they have the opportunity, they have everything, but they don't want to buy the TV. They don't want to buy the car because everybody thought that this is going to be like, oh, they have all this excess saving, and then they're going to just go and they're going to use it for, buying cars and durable goods and property. And But that's not happening because I think people are still scared of COVID. People are scared of what might happen
They
if
still
there's
have
another
COVID
bout.
over there, right? I mean, they
They
still
do.
have they have some really
Yes,
high COVID numbers, like
correct.
millions, I think millions of people a day, right?
Yes,
Yeah,
yes. So, and the problem with this is they don't know if this is going to spark another lockdown.
right.
What if it does? Because the country's unpredictable.
So I think it was last weekend, OPEC did another
Yes.
production cut. Like, are they doing that because demand is falling, or are they doing it because they don't like seeing the price of oil in the low 70s and they want it back in the 80s and 90s?
Well, it's the latter. Um, yeah, no, because and I've been pretty open about this, although we don't have. Okay, so let's put it this way. First of all, Saudi kind of went rogue and cut production. So they had their meeting, everything was well and fine and done, and everybody decided, okay, we'll keep the production cuts as they were. Nobody wanted more cuts, nobody did more cuts, and then suddenly after the meeting or towards the end of the meeting, Saudi came out because they came out with their official statement. I was watching the website, the ministry website. They came out with the official statement that we're keeping production cuts as is, and then I think 5 or 10 minutes later, they came out with a second. Um, News item on their website that said, "Oh, we're cutting another 1 million barrels." And this is just
Which is a big cut.
it is a big cut, and this is just for July. However, they say that they can extend it if they want. So the point is, the Saudis are doing this. They did it kind of unilaterally. I won't, because it's voluntary. It's not mandated. It's not part of the quota. It's not the published number. So they're doing this voluntarily to keep the price of oil high. Now, the one thing I've been saying for a very long time is that this region, in order for them to make their budgets and stuff like that, they need to have the price of oil at least at $75 a barrel, which is Brent, right?
Right.
And then you have WTI, which is like $4, let's say anywhere between $3 and $5 difference. So that's like WTI at 70, let's say. They need it above 75. My understanding now is that this number has changed for Saudi to above $80 a barrel. And the reason it's changed is because of all these fancy things that they're building now, right? So, they have this new development that it's going to be like a line, and they have the city, and they have the Red Sea project. They have various projects, like massive scale projects there. And in order for them to fund those projects, apparently now they need a higher price of oil, which is about $80 for Brent, which is about 75, let's say 76 for.
If they're able to get oil back into the 80s, does that make it harder for inflation to come down to that 2 to 3% target range?
Absolutely. Absolutely. I mean, it's a big, big change. I mean, last time we saw a higher or a hotter CPI print, not a hotter, but it didn't go down as we thought. PCE didn't go down either, and part of that was because of energy costs, right? And the US is a huge consumer of energy. Energy makes a big, big difference for the inflation numbers. So
where are we right now? We're at 5% year over year, ballpark.
So I have the numbers written down actually. So for PCE, we are 4.4% year on year.
Okay.
And for CPI, we are 4.9% year on year. So we're down from 5% the previous month, but still pretty sticky,
What are the estimates for next week?
I don't remember, but I think we're hoping that because of the base effects, we will see like a good decline.
Right, because like peak inflation was about a year ago, right? Because energy prices were so high.
Yes. I mean, but you're absolutely.
I went to Nashville, Tennessee about this time last year, and I remember that's when the gas stations were $5.50 a gallon, somewhere around there.
Okay. Right. So, and you're absolutely right that if the price of oil goes up again, you're going to see that transmit very quickly into the inflation numbers.
And then it also goes into transportation costs, and then you see airlines raising prices again, and
Yes.
Uber doing fuel surcharges.
So the funny thing about airlines, though, let me tell you something. There's a big lag between jet fuel prices and regular fuel prices. Okay, and so jet fuel prices always remain upward sticky, and this is why you have a situation where tickets are expensive. It's all of the maintenance, but also because jet fuel tends to be upward sticky because they want to create that buffer between this volatility in the oil price and the jet fuel.
So a couple weeks ago, we had a resolution to the debt ceiling. They
Yes.
extended the debt ceiling so we don't get a default. What does that mean? Like, where does that money come from? Does that now give the Fed or the Treasury the ability to start printing money again by issuing new bonds and T-bills?
Actually, it's just the opposite, right? So what's going to happen is the Treasury is going to issue bonds, and they're going to expect these bonds to be bought by people, by companies, by pension funds, international, national, whatever. I mean, but as soon as people start buying these bonds, the money transfers from your hands to the Treasury, right? So the cash is actually moving from the market, from you, from your investment to the Treasury. And so the actual effect is going to be a decline in liquidity in the markets, in the economy.
But I keep hearing there's trillions of dollars sitting in cash and money market funds. So wouldn't it be more likely to come out of that than like someone selling their Apple stock to go buy T-bills?
Absolutely, it could be. But here's the thing. Then you have a situation where that money can go to buy Apple stock, right? So either way, whether the money comes from here or here or here or here, wherever it comes from, this money, it had an opportunity cost. So this money could have been used to buy Apple. It could have been used for Apple to go to 250. But instead, what's happening is this money is now being routed to the Treasury. And if you have enough of the issuances, and we have enough, apparently they're going to issue $1 trillion.
That's what I
Plus,
heard.
yeah. Plus, you have QT still
Right.
going on, right? So now you have like a double situation. You have the QT vacuuming up, liquidity, maybe on a slower scale, but on a very accelerated scale, you have the Treasury now vacuuming out liquidity from the system. So it is going to affect the market. So this rally that we've seen from the beginning of the year, a lot of it has been because the Treasury was not issuing as much debt. So it's not that they were pumping cash in, it was just the absence of debt issuance,
Right.
So
Okay.
even that helped, let's say.
They weren't taking cash out.
Correct. And then a lot of people, again, instead of keeping money in deposits because they weren't earning anything, they're like, hey, let's do something with this money. And then I think part of that also entered the system. You had China trying to put in stimulus, not trying, they did put in stimulus, I think 2 or 3 times. You had Japan's easing policies. So everything combined, we have had quite an influx of liquidity that has driven this rally from the beginning of the year.
So part of the problem that caused these bank failures was people pulling money out of savings accounts and checking accounts that weren't earning any interest and buying treasuries, as yields went higher. And then that forced the banks to start selling their treasuries and fixed income assets in order to create liquidity to pay back their customers. Like, it's ridiculous. So are we now just going to go back into that where if rates keep going higher or stay high, you're going to continue to see more money coming out of the deposits and moving into some of these treasury securities?
So some of it will reprice now because we've been seeing rates go up for a while, right? So now they have the ability. So let me just take a step back and tell you one of the main reasons that they were not paying higher rates. It's because the loans that they had given out were at much lower rates, So they were in a situation. So for example, First Republic, they had a lot of fixed rate debt because they had a lot of mortgages on their books.
At 3%.
Yes.
2.5%.
So Correct. These mortgages were so low. So they weren't earning. So you're not earning, you can't pay more. So, and banks won't run at a loss. They just don't. It's one of the things, like they that's suicide for them.
Right.
Even though this is like worse,
Right.
but they never thought it would get to this point.
So
That's the problem.
what do they do? I'm just trying to think. Okay. If you're a bank and you give out a 3% mortgage to someone and rates go higher and now mortgage rates are 7%, like
Yes.
you're basically stuck with that 3% mortgage forever and ever because no one's going to buy it from you, right?
Yeah. 100%. Unless you want to sell it to people like at a loss. So
Right.
you can sell that to someone.
But then you have to take that loss, right, and reflect it on your balance sheet.
Yes. So at the end of the day, it's a no-win situation.
But are these banks marking down this stuff? Like, I'm just thinking,
No,
like
they don't need to.
they don't. Okay, because they can put it into their like hold till maturity portfolio, and they don't have to mark it down.
No. So they don't have to put it in any portfolio. So the loan is actually their product, right?
Right.
So that's actually what they're selling. So they can just hold it on their balance sheet, and as long as the loans are not delinquent, they're fine. As long as they're getting paid, they're fine. However, because the rates are so low, they can't afford to pay higher on the deposits.
Right.
And that's where the problem is. So that's the only issue. So it's not the issue that these loans are in trouble. And honestly, I thought that's why banks would blow up. I thought banks would blow up because of the credit issue, because people would stop paying their debt or we would have delinquencies. Luckily, that wasn't the situation, because if you had seen that, I think we would see a lot more banks going under. If people had started defaulting at a massive scale, it would be more of a 2008 kind of situation.
It seems like the new homes market is still pretty strong because I think we still have an undersupply of homes in this country.
Correct.
But is anyone selling homes? I mean, because if you have a house that's worth $1 million and you have a 2.5% mortgage on it, you go buy another house. Now your mortgage is going to double or triple. Is anyone doing that?
So I read an article a couple of weeks back which said that they're actually not. And then a lot of people are cribbing because they are stuck where they are. So some people want to have a bigger home because their family is going to grow. Some people, like older people, want to move into like a smaller home because the kids have left the home. So, but nobody's being able to move because of this situation.
That's crazy.
So I think the existing home market is pretty stagnant, but the new home market is still, kind of okay because what you said, there is a supply shortage. B, people have garnered quite a lot of wealth in the last couple of years, right? And so many have sort of liquidated their portfolios.
They're paying cash. Yeah.
Yes. So you have that. And then finally, you also have a situation where the job market in many, like, so to speak, the job market is tight. So as long as we still do have people who are employed and well employed, maybe they don't mind paying a 7% mortgage or a higher down payment. And therefore, the loan amount is smaller. So you don't mind paying a 7% mortgage if you're taking only 30% of the value as a loan,
It's just funny because like in 2020 and 2021, I had so many friends moving from home to home, moving across the country. And recently, like, I can't think of a single friend that has sold a house or bought a house in a year. But I look at like Redfin stock, I look at Zillow stock, and like they're actually been doing pretty well. So like, I can't believe the underlying businesses are doing well, but maybe people are just looking forward 6-12 months when the Fed will be probably cutting rates, and maybe that'll resume the buying and selling. So people are willing to look through some of this.
I think so. And I think people are pretty confident that the Fed will start cutting rates next year. So I'm not so sure it will happen as soon as we think it will. Maybe towards the end of 2024. But again,
You think that long? You think it could be 18 months from now?
look, it will depend on how quickly this tightening transmits through the system, right? Because until they get inflation under control, we can always see a situation where inflation has gone back up again. I don't know if you saw what happened in Australia. So this is good when you cover the global macro. You get to see a lot of things that may happen in the US because there are countries who started tightening before the US did. So Australia is one of them. And then they decided that, okay, we've done enough. We're going to pause. Everything's going to be fine. And then yesterday they did a surprise hike of 25 basis points, even though they said they were going to pause. And they did this because their inflation numbers came in much hotter than expected. And so they are now scared that inflation is going to take off again, and they didn't want to stop it in their tracks.
So their inflation came down and then went back up?
Correct.
What caused the new spike? Was it something as simple as energy prices or something
Energy prices, commodities, I mean, more of the same. It's nothing very different, right? Property. So I think everything considered, and then now they're saying they might hike 3 more times.
I mean,
because they're scared.
How much pressure is there going to be from politicians? And I don't know, I'm kind of answering this question in my head right now, but the deficit, the US deficit is out of freaking control.
Yes.
Like 30 trillion, 31, 32 trillion, whatever it is. And then we're going to add another trillion to that. I mean, we're going to be paying $1 trillion a year in just interest on that, right? To whoever owns those treasuries, which is China, Japan, etc. Like, at what point is there pressure from politicians to lower rates to bring down those interest payments? Or like, is there really nothing the politicians can do?
So ideally, the politicians shouldn't have a say, right? But I think, what could really, really move the needle would be unemployment. And I think once you see, unfortunately, and I don't like this part of macro, honestly, but unfortunately, once you see people losing jobs and the unemployment number going up, that's when you're going to see inflation really come down, because you're going to have mass scale demand destruction. And this time, not just for goods, but also services. People are going to stop going out to eat. People are going to, save, penny pinch, do whatever they can, just to get by, because it's a scary situation.
Right. And it's
people
not just
will start to save.
And it's not just when you lose your job, your friend loses their job, your cousin loses their job. Like, as soon as you start to see that happen, people will definitely pull back on the spending.
Yeah. I mean, like, I remember in 2008, 2009, well, for us, actually, it happened a little bit later. So by the time, we started to feel the effects of recession here, I think it was about 2010. And I remember, like, looking around me on the floor, and then one by one, everybody's just like being let go. Thankfully, I wasn't. But it's so demoralizing. It's such a difficult situation. It's so scary because you don't know if you're going to be the next one, and there's nothing you can do about it, because it's not like it's because you're not performing. It's just because the company doesn't have money. It's as simple as that.
So even if inflation comes in, I don't know, let's just say right now it's 4.9%. Let's say next month it's at 4.5%. I'm just making up numbers. I mean, that's on top of 8-9%, whatever it was last year. So we're significantly higher still from where we were 2 years ago. So even if they get inflation down to 2%, that's just 2% on top of what it was the year before. Like, do you think Jay Powell in the back of his head would be all right with some deflation, or is that like, that's just, don't ever go there?
So look, I know a lot of people have been talking about deflation, but to be fair, I think inflation is on his mind right now. Deflation is like,
we'd have to see like 6% unemployment to get to deflation, maybe?
I think so. And I don't think deflation is on the cards anytime soon.
Okay.
Not with the global dynamics the way they are right now.
Even though, like, I mean, from a consumer standpoint, like I would not mind deflation because everything seems so much more expensive now. Everything seems like it's 30-40% more expensive than it was 2 years ago. But I also know deflation means you're in a bad recession. People are losing jobs.
Correct.
People are defaulting on their homes. And like, that's an uglier situation.
Yeah, that becomes like a depression, right?
Yeah, right.
Yeah.
Nobody wants that.
No.
I mean,
we certainly don't want that.
No, I'll pay 30% more for stuff if it means all my friends don't lose their jobs. Ayesha, thank you so much. Really appreciate the conversation today. Anything we didn't get to cover that you wanted to talk about?
No, I think, look, in terms of sectors, I just wanted to put this out there. Two sectors that we are looking at, one long, one short. Personally, healthcare, okay, for all of the reasons that we did discuss earlier.
Long or short healthcare?
Long healthcare.
Okay.
Particularly long hospitals and clinics, physician centers, physical, therapy, stuff like that.
Is it just as simple as aging population?
So it's two things. One, you have the pent up demand, right? Okay. And then secondly, you also have the situation where people are genuinely sicker after COVID. A, because either they've had COVID, or B, because they haven't had COVID, but they've been at home for so long. Now they're coming out and they're getting like all these different viruses, and it's making them sicker because they've been sheltered for 2 years, right?
Okay.
So unfortunately, but healthcare is ramping up again. So that's one long that we're looking at, and also because of the labor dynamics there. And then the second is, for a short, I would say industrials, but industrials except for defense. So I'll keep defense out of this.
Industrials, because if we go into a recession, you would expect them to underperform.
So look, I think with industrials, you're looking at all the data, right? You're looking at ISM, new orders, manufacturing, all of this is going down, 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 down. Now, industrials have had peak margins. So if you look at Caterpillar, Deere, their margins have been the highest they've ever been in the history of these companies. So what you're going to start to see is that many of these high margin products or high margin situations are going to start to come down. You are going to see margins deflate. And if you look at the cycle, it's usually the situation that these companies are kind of doing okay until the Fed pauses. But once the Fed pauses, these companies start to feel the pressure of their margins coming down, of their sales coming down. So regardless, the very simple situation is, if you look at industrials, they have been soaring. And this can't go on forever, right? A lot of this is going to start coming down. You're going to see margins revert. You're going to see demand come down, manufacturing, all of that. So industrials would be a short.
And you said not defense because you think countries can't afford to cut their defense spending budgets, and they'll have to replenish their arsenals after the war.
Yes. So I did put out a note on defense as well, and we did some research on the budget. I was waiting for them to talk about what they're going to be cutting for the debt ceiling. They're not obviously cutting defense. So defense budgets are strong. And an element of defense is also space. So space basically means, all your satellites, and, you have Lockheed Martin, Northrop Grumman, all of these people, they also have these satellites and space technology, let's say. Huh. So space and communication, so space communication, that kind of satellite.
I like this call because medtech. So medtech is actually my biggest overweight right now in my portfolio, sort of for the same reasons that you just said. There's a lot of pent up demand for surgeries, procedures, aging population, and these companies all have great margins, great moats, huge IP portfolios, patent portfolios. So, once like Intuitive Surgical, like once you become the leader in robotic surgery, like no one can catch up to you. So
Yeah.
if this
And
huge,
if you consider this, Jonah, so like for 2 years, if I'm putting off care for 2 years, God forbid, a simple situation can become surgical.
oh,
You
for
know what I
sure.
mean?
Yeah.
And so, unfortunately, you're going to see a lot more surgeries. And so, you're bang on when you say that, medtech and intuitive surgical. So, I'm really liking the healthcare names.
Okay. Cool.
The hospital, HCA, THC, yeah, all of these, they're good.
And they're sort of, I mean, they're offensive and defensive.
Correct.
I feel like they have pricing pressure and people are getting older. And whether you like it or not, if you have to have your knee replaced, then you got to get your knee replaced,
Yes.
or your heart,
Yes.
or brain surgery. Like if it has to be done, it's got to get done, regardless of what inflation is. So
that's right.
Well, thank you so much. I'm glad we got a chance to do
Thank
this.
you.
Let's do it again. And I know you're a Bulls fan, right?
I am. Well, Michael Jordan, really. Michael Jordan and Pippen.
So
that tells you how old I am.
Who's the GOAT? Who's the GOAT? MJ or LeBron?
Do you have to ask Michael Jordan?
Well, I'm asking because someone actually asked ChatGPT who are the best 50 basketball players of all time, and ChatGPT actually had LeBron ahead of MJ, and I don't like that.
Why is that though? I mean, was it did it have something to do with statistics or something?
It's probably about LeBron scored the most points ever, so they probably put it's skewed for that reasons, or more seasons, more trips to the conference finals, that sort of thing, probably. But MJ is the best ever, no doubt.
Yes, he is the greatest of all time. Agreed. No doubt.
Well, thank you so much. Appreciate it, and look forward to talking to you again.
Thank you.
Have a good day. Bye-bye.
You too. Bye.